Well, in consideration of everybody's time, I want to start. I'm actually late, 11:01, but we're close enough. So we're going to talk about socially responsible investing. And if you didn't get them, there were a couple of stacks of handouts there. They're just two different pieces, basically some information pieces on socially responsible investing in general. They don't talk about specific funds or recommendations, but I think it might be helpful for folks kind of new to this topic. I want to start off, first of all, my name is Dallas Otter. I'm with Kibble & Prentice. Our role with the plan is as what we call a co-fiduciary and investment advisor. So I help the SPU Investment Committee draft what's called a statement of investment policies that laid out what types of funds would be made available to participants and the criteria that would be used for evaluating those funds on an ongoing basis. So it becomes a very objective process. We've got a committee of, I guess it's about 6 people, and every quarter we meet, we look at the fund's performance, expenses, volatility, style, manager tenure, all those issues, and we make sure that those funds are meeting the benchmarks within the investment policy criteria. If they're not, they go on a watch list. If they don't come back into compliance, then they're slated for replacement. I would expect maybe a fund a year to be replaced, so I wouldn't expect a high attrition, but that's kind of the process that I am involved with. One of the topics that probably got the most discussion when we talked about funds that we wanted to have on this, what we call a core menu, is socially responsible. And the first thought was we got to have a socially responsible fund because people have access to one now in TIAA-CREF, probably also with Fidelity and probably with Vanguard. And we said we want to maintain that continuity, and we're going to be mapping people from existing fund positions over, and we want to make sure that there's a counterpart that they can use. The more discussion that was put to that, the more kind of diverse positions and philosophies we had on what this socially responsible fund should look like. And there are so many different iterations and definitions of what socially responsible is that we thought maybe the better approach would be for people to use the brokerage window option, be able to select their own socially responsible fund based upon their philosophies and their definition of socially responsible. And maybe it's a function of multiple funds. That being said, we're still open for suggestions. So if after this meeting or any time in the future you say, look, I don't want to pay $50 a year, might be one of the issues. I want a socially responsible fund in the core menu. I don't want to have to go through this brokerage window to set this up. And if that's a strong desire and we get enough input from enough people, we'll probably come up with some kind of a broad definition socially responsible fund. There's an index fund that's got, I think it takes the S&P 500, it has a series of screens that applies to that S&P 500, basically liquor, firearms, gaming, tobacco, and you end up with about 400 companies left, and that's a socially responsible index, and you can replicate that index in the form of a fund. So the possibility of a socially responsible core fund is not out of the question, but at this point, it's going to be through that brokerage window option. Okay?
What was the criteria again? The basic ones that you just said?
Basic would be liquor, firearms, gaming, tobacco. Then you get into employment practices, environmental issues. There's probably another half a dozen that don't come to mind. So, and that's one of the challenges. And I'll give you an example that came up with another client. Is we picked a fund using those standard screens: liquor, firearm, gaming, tobacco, and it was companies on the firearm side. It was companies that did not manufacture firearms. Seems like a pretty reasonable screen to have in a socially responsible fund. The fund that we selected ended up with the largest retailer of firearms. I think it was Walmart. And people said, "How can you call this socially responsible?" And the answer was, "Well, they don't make firearms; they just sell them." And somebody said, "Guns don't kill people; people kill." And you got into this whole discussion. So that's one of the challenges with these socially responsible funds is even when you apply these screens, I would say none of them are truly perfect based upon some people's definitions of socially responsible. So that's the thought behind the brokerage window option. I've when the piece that, well, actually in the PowerPoint presentation, and this will be made available to people, I think, on your intranet site, there's actually a list of recommended funds. So we've gone into a database of all registered mutual funds. We have screened those down to come up with recommended socially responsible funds in different categories: large cap, small cap, growth, value, international, fixed income. So you can use that as a guide. But I would also encourage you to do your own research and analysis on these funds. One thing I want to touch on, I talked about the $50 fee. It's an annual fee that Schwab charges for this brokerage window account. Most of the funds that I'm going to show you today are what we call, or what Schwab calls, one-source funds, which means they do not impose any transaction fees to move in or out of those funds. Doesn't mean Schwab does it out of the goodness of their heart. It means that Schwab is paid a piece of the expense ratio of the mutual fund to custody and provide all the trading platform for that fund. We've got a couple of funds that are non-one-source funds. So Vanguard, for example, is a non-one-source fund, and it doesn't mean that they have any disagreement with Schwab and that they couldn't go, Schwab wasn't willing to work with them. It's a function of the expense ratio on these mutual funds. Vanguard's expense ratios are so low, for those of you who've dealt with Vanguard, you know this, that there's no surplus in there for them to share with a custodial platform like Schwab. And you might be attracted to the one-source funds versus a fund that is going to impose transaction fees every time you move in and out of it, but put a little thought to the number side of it, because and we'll see this when we look at this slide, the funds that do not charge transaction fees, on average, will have higher expense ratios. So you're not paying anything to move in and out of the fund, but your annual expense ratio that takes a bite out of those fund returns is going to be higher. So, for example, you might say, I want to put $10,000 into this particular socially responsible fund, and I've got two choices. One fund that's going to charge me $50 to go into it, one fund that's not going to charge me anything. The fund that's not going to charge you anything probably has, in rough numbers, about a 50 basis point or about a 0.5% higher expense ratio. So you're paying $50 a year more in terms of annual expenses on that fund. You don't see it, it's all in the expense ratio of the mutual fund, whereas the other one cost me $50 to go into, but my annual fees that affect my net returns are going to be lower. So that should be part of the thought process here. Okay, and we'll keep this real open, so if you have any questions as we're going along, let's get them answered. I've got some basic PowerPoint slides on socially responsible investing, so I think this is going to be review for most people. I mean, most people are here because they're interested and passionate about socially responsible investing. So I suspect most of this is going to be a little bit of a review, but let's run through this and let me know if you've got questions. What is socially responsible investing? We're going to talk about socially responsible investment screening, different investment objectives, and then some of the resources that you have access to. It's a saying that I've always liked when it comes to socially responsible investing. So, as most of you know, socially responsible investings adhere to social, moral, religious, or environmental beliefs. They've got a high standard of good corporate citizenship. They consider investment impact on society. They build wealth in underserved communities, depending on the type of fund. There's $2.71 trillion in U.S. assets that are now in socially responsible funds. These are some of the screens that you'll see. Environmental sustainability, corporate governance, human rights, product safety, community relations, employee relations, tobacco, gaming, weaponry, alcohol, abortion, nuclear power. So you can see the layers of screens that you can go through with these socially responsible funds. Let's see. Yeah, these are just more of the screening criteria that can be used. These are just some stats. So from 05 to 07, we've had a growth rate of 18% in socially responsible funds. 1 out of every $9 is involved in socially responsible mutual funds. There are now 260 socially responsible investment mutual funds out there, which has grown dramatically over the last probably 5 years. The primary socially responsible index, which is called the Domini Socially Responsible Index, was up 9.5% from 1/1 of 90 through the end of 2009. So there is a I guess a position by some non-socially responsible investors that by investing socially responsibly, it's going to cost you money in terms of net returns. And I would say the data would suggest otherwise, that there's not a price in terms of return that you have to pay to be socially responsible.
Is that an annual rate of return?
This is an average annualized rate of return over that 20-year period of time. And we're also seeing a big increase in socially responsible investing through state pension funds, university endowments, and foundations. So it's becoming a big issue, and basically taking a position with your dollars is considered to be a very popular way to invest these days. So finding a socially responsible fund, some of the thoughts that you should put through this process is, what is your risk tolerance? Again, you've got everything from a short-term fixed income socially responsible fund that are basically short-term bonds or loans to socially responsible entities that they need for capital, and then you've got everything to small cap stock funds, which would be on the other end of the spectrum. So it's not as simple as saying, I'm socially responsible, I just want to be in a socially responsible fund. You've got to ask yourself, what kind of volatility or risk can I tolerate with these assets? And maybe it's a combination of 2 or 3 socially responsible funds that you blend together to come up with an allocation that meets your comfort level or tolerance for risk. What are your values? It's probably the biggest issue here. I mean, we could poll everybody in the room, which I'm not going to do, and people's definitions of socially responsible are probably vary widely. Which values are requirements? Examine your screening categories, research the fund, and obviously invest with a clear conscience. This is one of the screens or pages that you can get into on the Schwab site. And I found this a little challenging to get into this layer, so I've actually put the URL up there to kind of shortcut it. So again, you'll all have access to this through the intranet, but you can actually apply your own screens to that Schwab website and do some of your own searching on these socially responsible funds. This one I happen to use one source funds only. So this was for somebody who says, I don't want to pay a transaction fee. I don't care if the expense ratios are going to be a little higher on these one source funds. I just don't want to deal with transaction fees. You'd just look at one source funds. There would obviously be another option for all funds. So these are some of the funds that we've screened. You can see the expense ratios, and here this third fund down is a PIMCO fund, and that is a non-one source fund. So that would be a fund where you would be charged transaction fees to move in and out of that fund, and you can see the correlation in terms of the expense ratio. Very low expenses, about 0.5%. Another one is, I think this is a Vanguard fund, FTSE index, 29 basis points. So you can see all of the one source funds are typically going to have higher expenses. They're not unreasonably high, but relative to non-one source funds, Schwab's got to get its pound of flesh, one way or the other. So they're either going to do it through a piece of that expense ratio or through a transaction fee. I'm spending probably more time on this than you might think I should, but this is something to really put some thought to. If you're somebody who's going to have a piece of your paycheck deposited through the 403B plan into the socially responsible fund every pay period, you probably don't want to be in a non-one source fund and paying $50 each time that deposit goes in. If you're somebody who says, I'm going to take a chunk of my existing balance and I'm going to shift it over into the brokerage window and buy 10 grand or whatever the number is of a socially responsible fund, and every couple of years I might do the same thing, I might sweep a chunk of money over, then the non-one source funds might make more sense because the lower expense ratio even though you do have to pay a trading fee to go into that fund. Okay, and some people will say, you know, we'll take their contributions each pay period, have those channeled into a money market account in that PCRA account, build it up until it's $5,000 or $6,000, and then periodically sweep it into that socially responsible option that might have a trading fee associated with it. Okay, and by the way, Schwab has got some great folks to walk you through any questions like this. I'm also available. I'm not as familiar with Schwab's tools, certainly as they are, but if you have any basic questions, investment-related questions, I'm more than happy to answer those. Yes?
On the previous screen, which was their advanced screener, is it your understanding that that's the same regular screening tool that they offer to their regular account holders?
This is the same functionality, whether you're in the plan or not in the plan. My understanding is the same kind of web portal that you'd go through, whether you had an IRA or a retail account at Schwab.
Because we do have a separate Schwab account, so I'm used to how that works, and if it's the same one, then it'll be easy to kick into.
Yeah.
And the advanced one offers a bunch of additional filters that you can impose on your own if you want to know whether the manager was there for 5 years or more, what the beta is,
Yep.
a bunch of stuff.
Yep. Yeah, there's some great tools. It's just a question of how much time do you want to spend with that. I can tell you, we've got what I think is a very good analyst. He's done some pretty good screening on all these already. So if I were somebody who wasn't comfortable or didn't want to spend the time to do all the screening, I would feel comfortable recommending any of these funds, with a caveat that you're going to have to do some ongoing monitoring of these funds. You don't have to go in every week and look at them, but probably, once a year or so, you're going to want to go in to the site and make sure that those funds are still performing well relative to other funds and so forth.
I have a question.
Yes.
You mentioned a few slides ago about over the 20-year period, an average of almost 10% per year. And yet when I look at these annualized returns, they're nowhere near that.
Well, we don't have too many that have been around 10 years. What was the index fund? Well, that was a 20-year period, first of all. So you're right. If we look at a 10-year number versus a 20-year number, there's a huge difference. In fact, I think the S&P 500, which is a broad index for the U.S. Domestic equity market, is still underwater for 10 years. I think it's down somewhere around 0.5% over 10 years. It is amazing when you start to look at 20-year periods of time in the market. It's amazing how, I hate to use the term predictable when we're talking about investments, but the range of returns when you start carving the markets up over 20-year bands becomes surprisingly close. When you start looking at 10-year returns, you get quite a much wider range of returns during that 10-year period of time. But 20 years, and I can't remember the numbers offhand, but it's something like 8.5 to 11.5% or something if you took 20-year bands of time going back all the way to all the way into the 20s. So your point or your question illustrates a point, and that is if you're going to go into equities or stocks, go into them with a long-term horizon in mind, because stocks are surprisingly predictable over long periods of time. They're incredibly unpredictable over a short period of time. I mean, you take that a step further and look at one-year bands of the S&P 500 going back into the 20s, and you get everything from a plus 68 to a minus 50 or whatever the numbers are. Huge range of probable returns if you're only investing for a year, but that range of probable returns really tightens up if you look at a couple of decades. Okay. These are a couple of websites that I think are well constructed and very informative. And again, this will be on the intranet site. I'll leave this up a minute if you would just want to jot these addresses down. By the way, I just had some notes to myself that I wanted to touch on here. The three typical screening approaches that you'll see with these socially responsible funds are a qualitative screen, where they'll look at issues like employment practices, pollution issues, community involvement, those types of issues, and they'll basically give them kind of a ranking using, looking at those types of issues. The other is a exclusionary screen, where they're basically saying anybody who's involved in liquor, firearms, gaming, tobacco, and so on, we're going to cut them out entirely. So it's just an exclusionary screen. The other is a best in class, where they'll look at a particular industry and they'll say, based upon employment practices, pollution issues, community involvement, what company or companies have the best ranking from a socially responsible standpoint in their particular industry. That you might look at that company that's best in class and say, these guys are so far from socially responsible, I would never invest in them, but relative to their peers in that particular industry, they might be considered socially responsible. The energy industry would be a good example. I mean, even the people who get 5 stars from a socially responsible standpoint in the energy industry, a lot of those companies you and I might not consider socially responsible if we applied some of these other criteria to them. Everybody get these addresses? That's basically it. $50 for Schwab's once a year custodial fee, $49.95 as a transaction fee if you buy into that fund. The one-source funds have no trading fees, but you still have that $50 a year custodial fee to hold that fund.
$49.95 transaction is regardless of the amount of the investment?
Yeah, that's my understanding. At least that's what it looked like from the site. Yep, regardless of size. If you're putting in $50, it's going to cost you $49.95, $10,000.
And is that just your personal contribution, or is that the employer's contribution?
It's basically any dollars that go into that fund. So if you take a chunk of your pension plan, bring it over, still $50, and it's seen as 2 separate trades in their eyes. Yeah, so you might have a balance in the 403B in a particular socially responsible fund and a piece of your pension balance in that fund, but that's 2 separate trades as far as Schwab's concerned. That's my understanding. It's all.
And you're going to pay the $50 on both plans as well.
So what happens on a monthly basis when our money goes into those funds? Are we constantly paying transaction fees to enter funds that are not?
If you are going into non-one-source funds, which would be the 2 that are ends there, you're going to pay that $50 every time money goes into that fund, whether it's once a year, whether it's every pay period. If you're somebody who says, I don't want to accumulate money in a cash account and move it over. I want this to be autopilot, and I'm going to take, half of my 403B contributions and I'm going to channel them into the socially responsible fund, or maybe it's all of my contributions, then you're probably somebody who's going to want to lean towards the one-source funds and not have to deal with that transaction fee. So in that case, it's just $50 a year, and if you have 26 deposits a year, it's 0 as far as the cost of buying into that fund. So, the one-source versus the non-one-source is not better or worse. It's just a question of kind of looking at your situation. Are you somebody who's going to be trading a lot, whether it's just buying in every pay period, or somebody who likes to move things around? You probably want to be in one-source funds. If you're somebody who says, I'm going to take a chunk of money, put it in there, leave it alone, and maybe once a year I'm going to sweep some money into that, then the non-one-source funds would be fine with the lower expense ratios.
So in the non-one-source funds, you could actually have your funds going all into some account where they're kind of holding the money,
Yep.
and then once a year go in and move it into the actual
What I
fund.
don't know is, could those be kind of a standing order where you can say, once I've accumulated X amount of money in this money market account, can it be automatically swept into the fund?
You might be able to do that like quarterly.
Okay.
Schwab has those services.
So you would say quarterly, regardless of how much money is in this fund, every quarter sweep what's in this money market fund into XYZ fund.
I apologize for coming in late, but there's been a lot of talk about Schwab. Is that the only option?
At this point, Schwab is the custodial platform for that PCRA account. Doesn't mean that you can't use another advisor or another broker to give you advice, but the assets have got to be held at Schwab because those are all linked to Diversified in terms of their system. Yes.
So back to where the money could go, it sounds like in creating this through the brokerage window, you're essentially creating like an account with Schwab, and you could have the money go into a money market or some other non-transaction fee, cash-based, highly liquid, could then be set up whatever, quarterly or however.
Yep.
But it's still going to be considered a segregated retirement account, so we avoid tax consequences.
Absolutely. Yeah, this is still part of the trust, whether it's the 403B or the pension plan. If you buy something for $10 a share and sell it for 20, no taxable event until you take it out of the back end.
And if you have a Schwab One account on your own outside of this retirement plan, those two will not be commingled. When you log into the Schwab, you will only see the PCRA in your retirement account. You won't see your other Schwab assets if you have any.
But on one of the tools that Schwab's got, I believe you can link those other Schwab accounts to it if you wanted to roll all those together and use that as part of your planning.
You might be able to for the planning purposes, but mainly when you go in the first time, all you're going to see is
Right.
you're not going to see your other taxable accounts or any other plans that you have.
We have a Schwab account and talked to the guy there about it, and there's already a system where if you have multiple accounts, which we do, there is a screen that will show you a summary of all this, and there's even a device that you can punch a button and it'll show you your portfolio as though it was merged, even though they're highly segregated accounts.
Mm-hmm.
But it's his understanding that this particular brokerage window system won't be readable by their portfolio system. You'll be able to call it up and see it, but you can't push a single button and go, what's going on?
Okay. That I'm
It's
not
not a big loss.
Yeah, that I'm not sure of.
And this brokerage window, while it's being set up so that we have access to the socially responsible funds, it's not actually restricted to only the socially responsible.
Absolutely not. Any registered mutual fund, and what are there, 8,000 and change, or 11,000, I can't remember last I heard there were more mutual funds than individual issues of publicly traded stock. But yeah, it's just, and that's somebody asked if it could be opened up to actually individual issues of stocks and bonds also. 403B regs, at least currently, only permit investment in mutual funds and annuity funds. So until that changes, that'll be the way it stays. But that's a huge universe of funds that you'll have access to.
Yes, one more word of caution on the Schwab. Some of the funds that are available through Schwab are also in the core lineup of your plan to begin with. So you don't want to go to Schwab and invest in a fund that's probably going to have a higher expense ratio and maybe a transaction cost when you can get it through the plan as one of the core offerings. So
Yeah, none of the socially responsible funds, obviously, but yeah, if you had your brokerage window and you said, I'm going to screen large cap growth funds, and you found what you thought was a fantastic fund, paid your $50 to set up the account, and maybe it was even a non-one source fund, so you're paying transaction fees, and then you realize that that same fund is available on the core menu with no transaction fees and no custodial costs. So you're going to want to make sure that you're not spending more money than you need to. Yeah.
Diversified has a number of tools that allow us to take a look at our portfolio, project into the future, income possibilities, and so on. And when we move through this brokerage window, it appears that will not necessarily be included then in those tools that are available to us. Is that right?
I'm going to let you feel that. I'm not sure.
Well, you'll have to add it. You'll have to add in the asset classes. The dollars will actually show up, but how it's invested, you can add that in the planning tools to have it work properly.
So if you had 10 grand in the PCRA, 5 of it was in a large cap growth socially responsible fund, another 5,000 was in a fixed income fund. You went over that tool, it would show a $10,000 position, but you'd have to tell it that you've got 5 grand in large cap growth, 5 grand in fixed income, and then it would bring that into consideration.
Yes.
Actually, I noticed you do have TIA Craft Social Choice. Does that actually continue as an option through the brokerage window?
Mm-hmm.
Yeah. It's part of the one source as well.
Yeah, so TIA Craft has a lot of registered mutual funds that you could use through the brokerage window. And that's been one of the discussions, is somebody said, look, even though TIA Craft may not have made it onto the core menu, I really like TIA Craft. I like their philosophy. I've used the funds for the last 20 years, and I want to continue to do that. You could actually use counterparts to the annuity, the variable annuity funds you're in through TIA Craft. You can use mutual fund counterparts within the brokerage window account. So you could say, not only am I going to keep my existing balance in TIA Craft, which you all can do the way those contracts are structured, nobody can control those dollars except you as the investor, but I want to take my new money and continue to direct that into TIA Craft funds. You will be able to do that through the brokerage window. And I believe most of those TIA Craft mutual funds are one source, most if not all of them. So you'd have the $50 annual custodial fee for that brokerage window account, but you wouldn't have any trading fees to continue to put money into those TIA Craft funds.
It's a question that's not so much about the socially responsible or the Schwab part, but it relates to some of the materials we've gotten earlier in the broader sessions, but it's going to come back to this. If we did nothing, then it's becoming increasingly clear that there's an excellent system set up where you've done the fund mapping and you've found some similar funds, and stuff will automatically go over for some of our accounts and not others, and you've been very clear about which of those they are. If we have funds where we do nothing and there's that transaction, the mapping transaction, it goes into something else, the way this is all working, if we then wanted to put those assets to work in one of these, sequentially would we wait and have that mapping done?
Yes.
And let it land in the new place, and
Yes.
then give instructions to move that through this window to one of these social.
Yes, exactly. Yeah, so that's, as I understand it, right after, was it the week of the 10th of October, things will be live. So at that point, all those dollars will be mapped over. You'll be able to go in at that point and set up that brokerage window account and shift into that. But unfortunately, it's got to be that stepped process. Yes.
Now, when everything is mapped over, then we're going to be paying a $50 per fund.
No, good
fee
point.
To
But
set up new accounts.
good point, but that's not the case. So on the core funds that you'll have access to, or that you'll be mapped into if you do nothing, and let's be clear on that. You've got TIA Craft, whether you've got that, and I can't remember if that's in both plans or just the pension plan, but TIA Craft, the way the contracts are structured, the plan sponsor cannot move those assets, and if you want to do something with those assets, you have to initiate that process. So those dollars are going to stay where they are. Fidelity has the some of the assets that are that way. I believe they're on the pension side. The 403B assets can come over. So anything that can be mapped will be mapped. And if you're in the Fidelity Large Cap Growth Fund, you're going to be mapped into the new Core Fund Large Cap Growth Fund. But on all the core funds, there are no trading or transaction fees. They may be non-one source funds. Okay, and I want to make that distinction. You might pull them up on Schwab's website or on one of DIA's, it would be on Schwab's site, and it might show as a non-one source fund and normally would incur transaction fees, but because it is part of the core menu, there are no transaction fees associated with that.
But if you then were in that non-one source fund and decided to take some or all of it to move through this window to do something else, there would be a transaction fee for the exit.
Nope.
No?
No, not on the selling side. It's just going to be, once you hit that PCRA, either going into it, depending on what you're buying in that PCRA, and then what you sell once you've got money in that account, that's really where you're going to generate those transaction fees. Okay? Any other questions? Yes.
If we choose to use the brokerage window, would that also include the privilege of sitting down with a local person from Schwab, let's say, to get advice?
My understanding is yes. You've got access to Schwab's folks over the phone, online, as well as through the retail branches.
Or would it be better to sit down with somebody from Kibble and Prentice or Diversified?
I would say either way. I mean, Diversified, and jump in if I'm not accurate on this, is really shouldn't be giving investment advice. I mean, they're the record keeper, the custodian. They'll walk you through the tools that they have to give you the knowledge to make decisions. But I don't think you guys are going to be in the position to say, we think you ought to be in this fund. So I would say Schwab or Kibble and Prentice would be your better avenues for specific advice. Or I've done some screening and I've narrowed it down to these 3 funds. They all look pretty good. Can you give me some guidance on which of these 3 might be the better of the 3 funds?
And would there be a fee for that advice? Or?
No.
Okay.
No. Certainly not from us, and I don't think from Schwab. Okay. I can't think of anything else other than I want to emphasize that this is and was and is an area that got a lot of play and continues to get play in terms of the investment committee. If you find at any time that that there might be a better mousetrap, or that you would rather have a core fund, it's probably not going to be multiple core socially responsible funds. I mean, it's going to be kind of one vanilla socially responsible fund. But if that's something that is important to folks, then let that interest be known, because this is your plan, or these are your plans, and if there are things that you think should be done to make them better, those are the types of things we talk about as an investment committee. Okay, thank you for everybody's time.